Very good morning. Welcome to the third session of our monthly call, market update call. Basically, this is powered by Epsilon Money. Today, obviously, has been already said about the elections and the outcome that might impact markets. So today on this call, we have Mr. Tushar Pradhan with us. He will be taking us forward, and with him, we will be talking about the sectoral views and what valuations that markets are currently quoting. The very first slide, and very important slide as well, because obviously, right now and for the coming week and maybe for the coming month, we might talk a lot about markets and talk a lot about elections outcome on the markets. But overall, India is growing, and Indian economy and Indian GDP is on a rise. As we can see from the table on the left side of the slide, we can see that since the last decade, the GDP as well as the GDP per capita has only risen, right? And just last week, when the year-on-year data came for the GDP, overall GDP growth in the last year, India marked a growing economy of 8.2%, which, if we compare with the developed economies and the closest peer that we have with China, China grew at 5.1, whereas US is growing at only 2.2%. Obviously, GST collections are at record highs, and which is only rising. And again, India's weight, which is on the overall MSCI Emerging Market Index, it has increased almost, it has actually become more than double in the last 5 years or so. An unsettling calm. If just we talk about till yesterday, if barring yesterday we remove that day, yes, then we see that there has been a 0 day where markets have whether up move or down move of more than 3%, right? And it was uh, though elections and though a lot had impacted markets, there had been wars, there had been talk about rate cuts, there had been some or the other talks here and there, but markets had a very, the volatility was not seen. Even the volatility index that we talk about, it had only been, it had actually fallen to less than 10, and then it rose all the way to 25. So barring yesterday, when we saw deep, rise in volatility index as well as deep down move, uh, the markets had been more or less a settle and more or less calm markets. Obviously, when we talk about the central government policies, more or less, we are expecting that India will be forming the third time they will be coming back to power. Obviously, a coalition government. If we talk about the focus areas of the government across the last decade and maybe in the coming 5 years, it has been reforms, right? First was it in the first 5 years, it started with cleaning of PSU banks and reforms, whereas in the second tenure, it was setting foundations for manufacturing and industrial push. And obviously, government's push, and though more or less there was a problem with private capex, but it was more or less done by government were hugely investing into infra and hugely investing into industrial pushes. A third term might see continuation in policies, and obviously, some or the other, there might be a welfare policy towards, for the people who are actually at the bottom of the pyramid. Obviously, if we see at the left-hand side, manufacturing was, it still is. It doesn't contribute a lot to India's and a lot to global GDP, but it is on a rise. Obviously, if we see about the investments that are taking place in Indian markets and the Indian economy, we are seeing that the government's expenditure and the infra push that is happening, and obviously the manufacturing hubs that India is trying to become, there has been inflows. And obviously, we can see that, and we may witness that over the last or over the coming decade, the overall GDP or the overall percentage towards these things might rise. Talking about the stock markets, if we talk since 2024, markets have given phenomenal returns, especially if the last 5 years are taken into consideration. Mid caps and small caps have given phenomenal returns, right? If anyone had invested only 100 rupees at the beginning of 2024 June, when Modi government came into power for the first time, that money would have become almost 650 rupees, right? And that's the power of compounding we are talking about. But at the same time, valuations are not very rosy, right? If we talk about the mid caps and the small cap, Especially mid caps, they are quoting at a very high price, a very high valuations, and rightly so. If we talk about the earnings growth as well, right? There has been a marginal slowdown, or maybe the possible outcome would have been because of the peak margins that we witnessed in the last quarter. If we remove the BFSI sector, the growth was only 8% year on year, and obviously the top line growth was only 4.5%, 4 to 5%, right? Obviously, net flows remain positive. Sentiments are also more or less the same, but fundamentals need to catch up. After yesterday's fall, Nifty has obviously is slowly entering a fair valuations territory, last seen in October 23. But when we talk about the small and mid cap companies, they are quoting at a very high valuation, and future returns might be lumpy. If we talk about the sectoral view, if you can see the red line, that is basically talks about the FMCG sector. You see that it has the least, drawdowns, and more or less the returns are obviously on the lower side, but so are the drawdowns and so are the risk, right? If we talk about the last 5 years, especially, uh, as evident, right, since government was more or less focused on these areas, industrials, energy, and all the capital intensive sectors, they have given phenomenal returns. What now? And that is actually the talk of the town, that what now, whether government will go on with the policies or whether any new sectors might emerge, right? Basically, what we are witnessing or what we are seeing is more or less we are expecting normal rainfall, and obviously inflation is no more a talk of a town now. With lower commodity prices and maybe with some populist measure which the government might take, some of the other FMCG sector and consumer discretionary might make a comeback, right? Obviously, we talk about the valuations, and if we talk about the overall weightage that FMCG has, it is currently quoting at a 13-year low, right? And generally, it is seen when it is quoting at such low valuations and such lower under owned percentage, they have made a comeback. And obviously, pharma continues to deliver. Private banks, when we talk about all the five major private banks, right, the likes of ICICI, the likes of HDFC, they have seen a rise in their loan value as well as an improvement in CASA, right? And again, FMCG companies are focusing on premiumization of their overall products. They are currently offering, and they are coming up with new offerings and new products, which might lead to an increase in gross margins. Again, like I already mentioned at the beginning of the presentation, for the coming month or maybe an year, a lot will be said about the elections or the possible outcome of elections. But in the long run, only earnings matter, as evident. We can see that from 1999 to 2019, all the elections, right? Whether we take 1 week or we take 5 years rolling returns, the returns are pretty much same, and it only matters when you start and how long you can, continue investing. Obviously, the two rates that you see, it was more or less because of COVID in 2020, and the dot-com burst into 2000 again. So that is why the two rates. Otherwise, markets have overall given a decent return. Uh, Obviously, again, corporate earnings will, make a comeback. Again, corporate earnings will be seen how, stock prices will be impacted by them. Again, entering at very high valuations might lead to years of pain ahead. So I'll pass on the mic to Tushar, sir.
Thank you, Siddharth. Good morning to everyone. It's an interesting time because it is something that everyone will remember for a long time, I guess. So I think I'll begin with where Siddharth left off in terms of earnings growth and the expectation for the economy going forward. We have discussed this often, that while volatility is something which is ever present in our markets, volatility by itself does not decide where the markets are going to go. So in the interim, news events such as, in this case, I'm really surprised because it's not as if the ruling party is not going to come back to form government. I think as recently as yesterday, I think their coalition partners have confirmed that they are going to stay within the fold, and that they will have the necessary majority to make the government. So now, if you were to say, what is the reason why there is such a huge drawdown in the market? There is no precise answer for this, because the markets are, according to Mr. Warren Buffett, little, I would say, paranoid. So what happens is that every event, they accentuate the positive as well as the negative. So if I were to say that a normal person will go in a straight line, when the market goes through that line, and if it is excited, it will go upwards. It won't go to the straight line. And if it is depressed, even if the straight line is where it has to go, it will go below. So at each of the times when there is a huge amount of sentiment involved in the markets leave this straight path of earnings growth, because earnings growth is a percentage which is a linear function, right? So Siddharth's chart on earnings growth is something which I'd like you to recall of, Siddharth, if you want to just pull that back up. Will give you some idea that over a long period of time, when you're talking about earnings growth, this is something which we all should understand is the driver for stock market prices over the long. Now, if you were to say that earnings growth is going to be significantly lower because of this event, I think we need to readjust our view whether that is likely to happen. So during the time that we had, much more severe crisis, forget about a change in government. It was only what is known as the global financial crisis, where every bank was in trouble. It was not possible for everybody to imagine that banks such as Citibank or Lehman Brothers were at risk of being bankrupt, and what that would mean for the global economic situation, because almost everybody banks with them. And if you were to imagine the kind of chaos which that could have caused from a fundamental perspective, you will understand the difference between an event which causes significant drop in earnings for a number of years after the event, as opposed to an event which has really no impact on earnings, except for maybe a few companies, I would say. So this is the choice that we have to take from here on to decide whether we agree with what the market is doing right now, because you don't have to agree with the market. The market keeps changing its views. So right now, the market thinks that because it has significantly drawn down, that earnings are at risk, expectations of earnings may not be delivered, or the fact that the valuations that they were trading at are not now justified given the change that has happened. So these are the reasons that we can conclude the market is really nervous about. Now, let's put the ball back in our court. How are we to do and what are we to do about this? Now, we all know that we are investing for the long run. Equities are for the long run. And by the long run, I mean 5, 10, 15, 20 years. That is typically a term to be taken. Now, if someone has invested even at the peak, which is 2 days ago, of the market today, and he's looking at a portfolio which is significantly lower than what it was even 2 days ago, what does such a person do? First of all, he has to remind himself or herself that he has invested for the next 5 years, not for tomorrow, not for today, right? That itself should give him some confidence to say that even over a year, if my portfolio had come down, say 10%, but in a very gradual manner, it is exactly the same as it is today. So there is no difference between that and this. Second is, he has to remember that ultimately only the earnings growth is going to drive the markets to a certain amount of certainty in terms of valuation. Otherwise, it is always up to the sentiments for that time. If the sentiment is positive, like it was 2 days ago, the market will do what it will. If the sentiment is negative, the market will do what it is. But it has nothing to do with the longer-term reality of the equity markets. And the longer-term reality of equity markets is that it is composed of companies which generate earnings, profits. And if we believe that we are in an economy that is going to see unprecedented economic growth for the next 5, 10, 15 years, as opposed to what we have seen in India in the past for various reasons, then there is absolutely no reason to worry about the soundness of our investing allocation, even to equity, even at the peak of our markets, which we were investing 2 days ago. Okay, so that is the one thing I would wish to share, which will ensure that people will understand where we are coming from. Second is, for people who are worried about what will happen today, tomorrow, 1 week from now, or what will happen in the nature of the coalition, etc., all of these events, while it will impact the market, have nothing to do with the long-term expectation of earnings growth in our economy. Okay, so these are two very different things. So it is difficult. As I said, many people say when they look at the market, oh, the market is expensive, I need a correction. They don't invest because they think that the market is expensive. And when a correction happens, the attitude of the investor changes to say, no, but I don't know how long and how far it will further fall, so I'll even wait now. So in a sense, if we are not convinced about what we are doing, we will always be second guessing. We will always be looking at some expert. I hate to say that word because I'm called an expert at times, who keep giving advice like I am from time to time, depending on where the market is, what the economy will do, etc. But I think we have to remember that essentially we are not investing in markets, in sentiments, in events. We are investing in companies. Because if you buy a mutual fund, that mutual fund has a portfolio of companies. They have bought equity in companies. And if at all you are worried about what the performance of the portfolio is likely to be, it is important to understand what kind of companies exist in that portfolio at times. And then realize for yourself that if these companies are today, wherever they are, what are they likely to be 10 years from now? 10 years is a minimum I would give myself to evaluate what is the potential for any company going forward. Most of the time, we don't know the potential of those companies, and it's a good thing because many times companies surprise us significantly higher than what we estimate their growth to be. And in a country like India, I have hardly seen any company which has not only delivered on a basic ability to generate earnings on a regular basis, but no matter what, most companies in India have managed to grow. And that is encapsulated in the larger term, what we call as gross domestic product or GDP. Now, what is the estimate for GDP growth in this country? If we take any estimate between 7%, 6%, whatever it is, you add inflation to it, and there you will get a little bit of an idea of how likely earnings are going to grow at. Because earnings are not real or adjusted for inflation. They have inflation in them. So if I add inflation to the GDP number, I will get an average rate of earnings growth for whatever 1, 2 years forward that we can think of. So I think in a sense, what we need to do is to focus on the fundamentals again of our economy and not get carried away either by the fact that we had a significant overvaluation 2 days ago, or the fact that we are now in a situation where the sentiment has become extremely negative to think that something big has happened, something wrong has happened. I will give you something which might just give a comparison to what has happened today, is that the ruling party was not even able to do what it did today, which is have 240 seats, which is higher than all of the seats that the opposition alliance has put together. Suppose this was not to happen, and they would have had a tally which is less than that. Where do you think the markets would have been then? So that is an extreme situation, just to give you an idea that things are not that bad. The ruling party is likely to come back. And many people are saying that, oh, but now it is going to be the coalitions which will lead economic policy and not the BJP. Now, I will like to understand the two people who are very key in the coalition. I'm not a political analyst, but I'm just an average person, just like you and me. But if in our average view, Mr. Nitish Kumar and Mr. Chandrababu Naidu are my friends in an economic scenario, I would rather have them. Because if you know the kind of history of what Mr. Chandrababu Naidu comes with, He turned Hyderabad into Cyberabad. He was the first pioneer in understanding what technology can do. He invested very heavily in technology. And of course, his mistake was, as a politician, he forgot his vote bank, which is largely rural Andhra Pradesh, which could not understand what he was doing, and he was thrown out of power. It's a simplistic way of understanding where he came from. But let us not forget what his basic aim was: to increase the average earnings capacity of his state by investing heavily in technology. So that's your partner number one. If you look at Mr. Nitish Kumar, if you understand what Bihar used to be before he came to be the CM, I think there has been a dramatic change in terms of how his administration turned around the state from where it was to where it is. And if again I were to choose two people in a coalition, I will definitely choose these two people. So I think it is suffice to say that the market has overreacted, just like it does all the time. I'm not saying it has overreacted only this time. It overreacts on the upside and it overreacts on the downside. Now it is up for us to decide, if we have allocable resources, that does this event allow me to make a choice today? And that's for everyone to answer this individually. And I'm sure if you are working with Epsilon, I think those are the people that you will probably get some good advice about what to do now. And if I were to say that I'm already invested, then I will need to look at my asset allocation and decide whether was my risk allocation correct? Am I getting worried? I'm not getting sleep last night about the losses there are in the portfolio. Then you need to review both your risk-taking ability, your aim in terms of what you thought this money was going to do, and for how long it needed to be invested before you made that kind of return. I think most investors have a very, very near-term bias, what they call as recency effect. So they look at the last 2 years and compare the returns to what has happened in the last 2 years. I would think, again, it would be easy and helpful for investors to look at the longer term returns charts. You will find that the average is between 13 to 15% for the Indian markets. But there have been times where the market is negative. There have been times where the market is flat. There have been times where the market is 4% up or 5% down in the entire year. The last 2 years have been one of the 2 years which were on the higher side of average return, which makes up the average, right? So if you were invested throughout the period, you still are pretty okay. If you plan to remain invested for the long term from here on, you're still pretty much okay. Of course, people do talk about timing, and I think the most astute investors realize that timing is not possible. And could you really time the last two events that have happened in our markets today? The flat answer is no, because nobody knew how the voter would vote, right? So when I talk about lack of understanding of what the market is going to do and then trying to do the timing in the market, stems from the fact that certain events are uncertain, certain events are unpredictable, and that's what the market is all about. What we have to do as investors is use the volatility to our benefit. And when I mean use the volatility, of course, it's a simpler thing to say that whenever there is volatility in the downside, it allows us to enter at a lower price. And when there is euphoria on the upside, it allows us to reallocate. Now, it is easier said than done, as I said. The sentiment and the behavior drives what we actually do. We were more likely to invest when the market was going up, and we are less likely to invest when the market is falling. That is behavior. That is human behavior. It is driven by greed and fear. But as astute investors, as myself being associated with the markets for the last 30 years, I can assure you that there have been much worse times in the past that I've been on calls like this and answering questions from investors. And I mentioned to you the worst time that I had when in the year 2008, people were asking me, are you trying to tell me that Citibank going bankrupt is not a big deal? And I had to answer that. So you can imagine that Citibank survived, but some of the other banks did not. But if we were now look back at 2008 in the overall returns chart, you will have to really, really focus on that area because it is a blip. It is a significant drop. It was a 50% drop in market valuation, 50% for 1 year. So you can imagine the damage that that event caused. And if I have lived to tell the tale, maybe my white hair is largely for age and not because of the stress. I can assure you that if you're investing for the long term, even in the worst of times in the market, even if you are invested already, I think the best thing to do is continue to evaluate your asset allocation. Be comfortable with the level of risk you have taken in the portfolio. And if at all you think you need to change, this is not the time to change on the reevaluation of your asset allocation. If, however, you are not allocated and you want to do a risk evaluation right now, then decide the risk allocation, knowing what kind of drawdowns a single day can bring, and then allocate a little bit into equity assets, which over the long term beat every asset class there is. So I think these are very factual statements I'm making. I'm not making a call on what's likely to happen, whether the market today is expensive, cheap. I think everyone has their own evaluation to decide that. Historical valuations help, comparative valuations help. But you should not forget the fact that Indian markets are not insulated from global markets. Indian markets are not insulated from events. Indian markets are not insulated from sentimental swings, which can be caused by anything. But what we need to remember is that they will always be what they will be. And it is not that every month that you come in, you make money and you continue to keep making money every month. It does not happen like that. It is an average return, and these averages are calculated as the total return made in any particular month or a year, and then averaged over that period. So you have to remember the calculation of how average return comes. It is not per quarter, per year, per day return. It is the average return over that period of time. That continues to remain secure. And if you extend the number of periods on which the average is taken, you are in a very, very safe position, no matter what happens. But if you want the money in 1 year's time, you want the money back in 6 months' time, I have no answer, because we might be in a better state from where we are, or we may be in a worse state from where we are. There is no way to predict, what the market is going to do in the short term. However, what we are investing on is the basis of the fact that the Indian economy is poised for unprecedented growth as opposed to what we have seen in the past. Companies have a tremendous advantage, and I don't want to go into the positives right now, but some of the positives are the expansion of the supply chain globally, India being open to opening up its defense, I would say, infrastructure for local manufacture, leading to significant opportunities for those companies. Having a significantly open attitude to business and having done very significant economic reform by way of GST, the bankruptcy code, the change in the banking norms, etc. All of those having already been done, we are in a pretty good state compared to where we were 10 years ago, 15 years ago, etc. So that is all I wanted to just share with all of you. I remain invested throughout this period along with you. I have tried to not take any timing bets, though I get tempted from time to time. But I continue to stick to my investment allocation. And if there are individual opportunities which come up, these are good times to invest. These are not bad times to invest. But again, I must say that it comes with the expectation that you're going to remain here for a longer period of time, and not just these investment returns about what will happen as soon as I invest in the next week, 1 month, 6 months, even a year. So some of these investments can take a long time for you to deliver. But I think we are in a good space right now. With that, I thank everyone who has joined here and would like to open it up for any questions that you may have. You can even put those questions in the chat, or you can just unmute yourself and ask the question.
Tushar, if I may ask a question, I take the liberty. Uh, Obviously, right now, what we have seen in the market reacting to the news flow, the election results, and everything. But there are sectors which are being like beaten down completely. So, if somebody wants to take a tactical allocation to a few of these sectors, right? So, can that be looked at? And if that can be looked at, what are the sectors that you think should be up for a tactical allocation?
Yeah, that's a good question. And this clearly has to be clarified that this is for more informed investors. This kind
Yes, yes.
of advice that I'm giving is not for general investors at all. So given that, and someone who has been closely following certain sectors, the first sector that comes to mind is banking. You are seeing a significant drawdown across all banks, and for no fault of theirs, especially public sector banks, which were riding on some expectation that there will be some radical asset sales of some of these public sector banks, etc., to strategic investors, or the fact that the government is open to divesting of public sector entities, etc., which was driving a lot of this valuation upside in some of the public sector enterprises. I think one has to be careful. I have made some comments in the past regarding the constraints that public sector enterprises have, and it's there on my blog as well, where no matter how much you think, the valuation differential cannot be equal, because these companies are government owned, and profits alone are not their objective. They talk about social equity, they talk about making a change in the environment, etc., is one of the goals that they run business for, which does not translate into a private bank, which has shareholder upside and purely profits as probably a principal reason for their existence. So I think between the two, you have to distinguish where is it that you find fair value and decide on that. If I take another sector, say defense companies, I have always been of the opinion that defense is a very tricky subject, because if you take a simple project like the Tejas fighter, for example, it has taken them 15 years before they actually came across even a prototype, 25 years before they could deliver the first model. And now HAL is saying that I can deliver so many in 1 year. So you can imagine how long a wait it was for investors in HAL to really make any upside. Right? Now, because suddenly all the stars got aligned and suddenly everybody thought that this was a great opportunity, etc., they got revalued at one time. My answer to that question really is like this, that nothing has changed. So the upside in those companies remain what they were. The only thing that has changed is the sentiment regarding how do you value those companies. It's not about the earnings growth. The earnings growth will be there. But if I was paying 20 times before and I said even 30 times I like to pay, it is a 50% increase in the valuation of the company. And this is what we've seen in some of these public sector companies, going up 100%, 150%, 4 times, 5 times in a period of 2 years. Now, does that mean that the opportunity there is not there? No. I'm just saying that one has to be more realistic about where the valuation has now gone, and made a little bit of a reality check about what they should trade at. So again, no very easy options to say, okay, some of these stocks have really got smashed, so is there an opportunity to go back and make money? If it was so easy, we all could make money. But if you give some reason, there were these manufacturing companies, industrial companies, which started doing very well, especially in the last 6 months or so. They have got hit a lot. And I think, again, there might be a good reason to kind of recheck that side of the story, that has something really fallen off even their average valuation over a period of time. There might be an opportunity there. If you look at chemical companies, the whole oil sector, which is driven by the price of crude, etc., raw materials being oil derivatives, I think there might be an opportunity there. Some of them may have been smashed for various other reasons as well. The China plus one story remains very, very positive. So if you find some opportunity there in terms of any stocks which were supposed to be the China plus one, and if they have got significantly damaged beyond value, which is fair, I think that's another opportunity one can get. So I would think that broadly these things come to mind, but specifically, I'm sure you'll find something.
One more question from my side. Obviously, we have been hearing now that EU may supersede Fed in rate cuts, and that is expected this week. Obviously, the scenario wherein we also expect the Reserve Bank of India to cut rate maybe a quarter down, right? So that's again a good opportunity when you talk from a combination of an asset allocation. We currently have a valuation which is cheaper than what it was yesterday or day before yesterday. And there's a debt which is also looking attractive. In this kind of a scenario, if a new investor would want to come in to markets and benefit from both aspects, right? So what would be your ideal asset allocation for such kind of a customer?
Yeah, this is a tricky question because when it comes to fixed income, there are no winners because essentially interest rates have to be cut because there is no growth. So we have to remember why the interest rates are falling. Also, the US is in a situation which is not so easy to understand as opposed to in the past, where there are no trade surpluses with them, there are no reserve surpluses with them, with the Federal Reserve as such, as in there. Central bank doesn't have any reserves. It is hugely indebted. The only sector in the US which is not indebted is the corporate sector, actually. They have a lot of cash. Households are indebted and the government is indebted. In such a situation, it is unlikely to think that the government's own debt is going to be under strain. And that means that the kind of growth that we saw in the US in the past was driven by cheap funding that the government raised and started investing a huge amount in infrastructure in the US. Now, obviously, the cheap funding has gone because the rates are high. So which means that there is going to be a reduction in that sort of growth in the US. Also, most of the savings which were collected by households in the COVID period, they're all spent it, and now they're again indebted. Credit card debt in the US also is very high right now. So when you combine all of this, it looks as if the US is going to go into a period of slow growth. If that happens, interest rates will come down and the Fed will oblige by reducing. But when it cuts interest rates, the bond markets cheer, but not for too long, because it leads to a situation where the economy really starts to slow down very dramatically. And that has other reasons to worry about what to do, because then corporate trade becomes a riskier place to be, and then some of the other places also become riskier. And given the fact that the US itself is so indebted, each of its states also are significantly indebted, which means if I buy state debt, if I buy government debt in the US, that play is not so much there for me to say it is going to be the same US economy which was 20 years ago. Interest rates have dropped and I'll buy government securities and make a lot of money. It's not the same scenario. Europe has its own reasons to drop rates because the slowdown in the economy there is significantly faster. So if you take the UK, for example, they are really headed for some very bad times. Economies are really in trouble. And that drop in interest rates may not translate into a dramatic drop in interest rates in India. So what is different is here our markets, especially our debt markets, are not that integrated. Our equity markets are fully integrated, but debt markets are not so much. As a result of which the interest rates in India really depend on the local demand and supply for capital. We don't have foreign supply coming in and we don't have foreign demand for money in India in any case. So the demand is domestic and the supply is domestic. Now, given the fact that we are possibly going to have significantly better fiscal deficits from here on, because we are on a fiscal prudence path, it is likely that the government is not going to borrow as much, which means interest rates have a potential for flattening, is my view. It may not drop because there is no reason to drop rates right now. If you remember, we drop rates only when there is no growth, or we worry about the economy as such, and then we drop rates. We are talking about an economy which is going to continue to keep doing well, and which means that the only I would say potential difference between this is that who is the biggest borrower in India? It is the government. But if its fiscal mathematics is getting better, it may not borrow as much, which will lead to lower interest rates, which will benefit the whole economy, but it is not going to dramatically drop rates to that extent. So I would think that someone who's allocating now should look at the YTM and be comfortable that they are going to possibly do little better than that. So if you're talking about a YTM in government securities, say between 6.5% to 7%, over the next 3-5 years, they'll make about 8.5%. If you're talking about gilts, which are trading, at the same yields, you will get slightly better over that period of time. But again, it's not without volatility. It will keep moving up and down. If you have the ability to stay for 5 years, you'll make a decent return in fixed income, but you will only make that return. Now, the contrast is in that period, the 5-year period that we're talking about, where equity markets likely to go. Again, it's an asset allocation issue, right? So I think good times, but it's a good point you said that for new allocators, it is not necessary for, I'll only refine that to say that it is not necessary for interest rates to dramatically fall to make money. You'll still make a decent YTM from here on fixed assets, on fixed income funds. But I would venture to say that some of the corporate, or let's say the credit risk portfolios, if they are high quality, they're yielding you a significantly better YTM. And given the fact that India will grow from here, if that's the base case, then there is security there. So you might, if you have that risk appetite, you might want to go a little bit into corporate debt as well. And that might be a bright spot, which will be without the volatility of the equity markets, but it will be around that sort of return.
Cool. Thank you, sir.
Thanks. I think there is one question on the chat, I thought. Archana Singh is asking which sectors will perform in the coming future. I wish I knew. I think, as I said, manufacturing is something which I'm really, really positive on. I like banking and finance because nobody likes it right now. I also like, what I would call the consumer discretionary, which is, all your appliances, tiles, everything which goes into discretionary spend, which is likely to continue to increase in India. So these are the sectors which I think I generally like. But again, the caveat is not that you can just blindly buy everything out there. Each of the companies within those sectors trade at a certain multiple. They keep changing from time to time. Look out for bad news and buy those at that time. Any other question from anyone or?
Hi, Tushar. This is Mayank. Just a small question. A lot of people who have been following the markets are a little concerned about the valuations that mid caps have run. Historically speaking, also, if you look at the data, this is quoting a little higher value than one can be comfortable with. So going forward, if India has to grow, there's another argument that if in a growing country like India, mid caps will be expensive. So, I'm not able to grasp the fact that how much overvaluation is good overvaluation.
That's a good question, which has no answer actually, but I will attempt to give you a little bit of a perspective on mid caps. So mid caps, if you look at the history of mid caps in India, that should not be the place to look at. Because you know how mid caps used to work in an environment in India which was very, very risky. You have to understand the mid caps of, say, when I began my career in the early 2000s, mid caps were very small companies. What was the definition of mid cap at that time? Today's mid cap definition is huge. So these are very big companies. So we're not talking about the same thing at all. So if mid caps had a severe drawdown at times, and I've seen mid cap indexes fall 60–70% in a year, I don't think that is going to happen now, no matter where their valuations are, because simply we are not talking about the same companies, right? We are talking about significantly large companies which gets classified as mid caps today because the sheer increase in market cap across the spectrum. So I would think that the fear that mid caps will suddenly lose all their value and have a serious drawdown, it's not something which I'm comfortable with as a scenario. It may not happen. But at the same time, what is an appropriate valuation? I think, again, it differs on not the fact that they're mid caps, but what is the company we are talking about? So if I take you back to the year, again, because of my age and my history, I can take you back to the time that Infosys was trading at 100 times multiple, 120 times, 160 times. And people used to say, it's a small company, you know, why are you giving so much valuation to this company? Now, the fact that not only Infosys, but every other technology exporter at that time was trading at the same value. Maybe Infosys was 160, someone else was 120, 100, whatever. There were companies which, you know, you may not remember the names, but they don't exist today, right? But they were trading at that valuation. Infosys survived. It generated a tremendous amount of money for all the investors throughout this period, even if you're investing at 150 times multiple. So it is not necessary to classify every mid cap to say that all mid caps will do like that. But as I said, significant difference between the mid caps of that time. So if Infosys was a mid cap at that time, and it entered into the large cap index, I think in 2000, I forget which year now, 1997, I think, if I'm not sure. So that's when it graduated from a mid cap to a large cap at that time. For large caps, you know, what the value was. Today, if you take the smaller technology companies, they have a market cap much higher than what Infosys was at that time. So we are talking of two different times. And again, the security that if they are a mid cap today, they're a very big company. They're a very secure business. But there, of course, the range of multiples is huge. So you've got to take a call. If such a large company is trading at such a big multiple, then it is unsustainable over long periods of time, right? But if it's a really, really small company where you have some particular knowledge about that, the potential of the company, and it is trading at a 70–80 multiple, that is a call you have to take that, look, I think of all of these, you know, this company is likely to do well. So it's an individual risk you take. And over time, as I said, an Infosys survived, it becomes a mid cap and then a large cap, and, you know, the cap of everybody else. So if you are catching on to one of those, it will be a successful story. If you had caught on to something else, which was as promising in the right sector and also was trading at slightly lower multiples than that, you would have been smashed. So the absolute valuation that you talk of is not something which will guarantee you success. It is more about your understanding of the company, the sector, and what it's likely to do. And in those times, valuations don't have a textbook understanding of what they should trade at. So it's more of a risk you take. So that higher valuation that you're taking on is the risk you're taking. And it should be willing risk to be taken. The best way to take that risk is to diversify. And the best thing I would say is to buy a mid-cap fund. Because
Absolutely.
then, you're not really putting all your eggs in one basket. Some of them will do well, but the ones who will do well, will you make you the money? So I would think that diversification comes in as a big key to making these decisions rather than saying, is the valuation justified? It is not justified. But only the earnings that the company will produce will justify the earnings today. But that's in the future. I don't know which company will do it or not. So it's a risk you take, and the risk is individual. So if you're willing to take the risk, why not? But there is no assurances there.
Just another follow-up question on that. And it's more, conjecture, a debatable topic that people are discussing these days. The emergence of mega cap in India, bigger fishes becoming bigger. That is one sector that one can look at, and that would probably beat all your mid caps and small cap ideas. So where do you think we stand in that debate in terms of Indian markets, and where do we head in the future?
Yeah, it's a good question, but again, which I don't have much of accurate answer on. So I will give you an example where I've seen a company which is a very decent company, large cap even at that time. But I had no understanding it will reach the scale it has, which is L&T. So when we talk about scale size, we used to argue that what are the kind of projects L&T will do in India, as opposed to a Schlumberger or some of these really large, I would say E&T companies, the companies which do very large projects all over the world. Because they have access to the entire world, they couldn't bid for these projects. They have the technology, people, execution skills to do it. And I used to ask, L&T doesn't have any of that. L&T is largely restricted to maybe India and in the Middle East max. And how much have they done? But look at the kind of projects that they're doing today. So was it possible at that time to understand they will reach this size? Your vision doesn't encompass that. So while it is possible that some of the companies that we have today will reach mega valuation status, people are arguing, why shouldn't Reliance reach it? Why shouldn't it? I don't know. Because they have the appetite, they have the capital, they have the access, and why should it trade at some of the other mega caps that are traded in the world anything lower than that? It's a question to ask, right? But I'm just using Reliance as an example, but there are so many such who have the potential. So you take banking, for example. And one of the things which are very interesting is, real estate companies globally trade at significantly higher market cap than what they are trading at in India. But that also is because of the nature of, the very, very distributed business that real estate companies and developers have in India. So there is a reason for every price to be. It is not without reason. So if you were to build a case that I'm going to pitch on a large cap becoming a mega cap, you have to look at the global opportunity. Only then you can satisfy. Or you have to imagine how large India will get so that, that company will participate in that growth. And in India, I think there's a decent reason to go there because who knows what the next infrastructure project and how large it is going to be. And which are the companies which will supply, large amount of equipment, capital, people to that. And those are the companies which are likely to become mega caps. So interesting idea, but I hope it was so easy to spot them.
Thanks, Tushar.
Thanks, man. So we are almost to the end of the hour. Thanks everyone again for joining in. Over to you, Siddharth. Abhishek, if you want to close.
No, thanks a lot, Tushar. As always, I think very sensible. People are getting too, I won't say worried, but people want to make a view out of what's happened in the last 2 days. A very bullish, so as to say, exit poll results, which are not the actual results, and a very, not a very different, but somewhat different final results, which still has continuity of the government. With lesser, strong mandate as it was, and frankly, as you said, it doesn't change much in terms of the direction of reforms, etc. So any such large movements is an opportunity to add for long-term investors, and we only mostly cater to long-term investors. So it just kind of works for us. Mid cap is an area which looks a little expensive, but it's been expensive for the last 20 years. And over the last 20, 30 years, if you see, it's still the best performing asset class. So, take it with a pinch of salt. And as Tushar said, volatility in itself may not be something that we have to over worry about. We have to put it in context. So mid caps still look like a very good investment bet if you are actually looking for a longer term investment. Maybe an opportunity to add more. Yesterday was a great time to buy some ETFs, for example, when it hit something like 12 to 14% on the downside. Great opportunity to buy ETFs. But again, we can't always tactically bet them, so it's fine. That's all. Thanks a lot for joining, and as usual, thanks Tushar. Really appreciate. So always, I've been hearing your views for more than 10 years now, and always very easy to connect, and makes a lot of sense. So thank you so much again. Thanks, guys.